Hello, this is Jim Musgrave with Research Financial Strategies, and welcome to my October market summary call. So given all the volatility that's going on in the markets, I thought it was a good time to actually shoot a video and tell you what's going on with the markets and to kind of explain why are the markets dropping and what's going on. So let's kind of start off with the GDP. So the U.S. economy is actually doing very well. 2017 has been good. 2018 has also been very, very good. But again, with the rising interest rates and the tariffs with China, we've seen a slowdown. I think that is the main thing that's causing concern, is the overall slowdown internationally with China, and basically just fear. So we're going to actually continue to see a slowing of the economy in its pace and continuing this year as well as in 2019. So again, the earnings we're right in the middle of earnings season. We've had some good earnings, so that's a good thing. But again, we're seeing a slowdown over the next few quarters. But again, just kind of show you here, we've had strong corporate profits have been strong, again, thanks to top line growth and margin expansion. And so we continue to see that. Again, the fear is what happens with the tariffs and slowing down in corporate profits kind of moving forward as the longer we get into this period of the tariffs. The Fed is also another reason why the markets have become very uncertain. So again, with rising interest rates causes ripple effects in both the stock and bond markets. And you can see the kind of projected interest rates moving forward on the blue line right here. So again, as the Fed raises interest rates, it's more costly for businesses and consumers to borrow money, and that also puts downward pressure on bonds, as we've seen, and I'm going to get in a little more detail on that in a few minutes. So again, interest rates are projected to keep on climbing. Who knows where they're going to land, but again, we still have some room to grow, the Fed to raise interest rates over time. Again, we're trying to get to that period of kind of normalized interest rates, and you can see that before the Fed lowered interest rates back in 2008, interest rates were certainly in that 4 or 5% range before the last recession. So we are in that kind of that painful transition and going into higher interest rates. And again, what's been challenging is the yield curve. So if you look at the gray line back in 2013, you can see how steep it was. And so the further you go out, there are certainly more opportunities to get higher yield the further you go out on the yield curve, just 5 years ago. But obviously that is not the case today. So it's a real challenging environment for fixed income. And the thing is if you got a long-term bond or a CD, you're not really rewarded for that very well. So that's one of the things that you need to do at this point, is certainly keep the durations of your bonds short. And if you're going to buy a CD, try and keep that short in that maybe that 12 to 18 month range in terms of buying CDs. And you can also see that the 10-year Treasury yields again have started to turn up over the last couple of years. Again, they're right around a little over 3%. And we also see that inflation is starting to pick up as well. It's not horrible inflation, but again, it is starting to pick up a little bit. So again, that's typically what we see with rising interest rates. So if you get maybe a couple percentage in a CD, well, the problem is that you actually have inflation that will pick up, and so you're still losing purchasing power. So that's the argument for not putting all your money into CDs and cash at this moment, because again, your purchasing power will be continued to be eaten away over time. Going back to actually looking at international equities versus U.S. So we've seen pretty much since this whole entire bull market since 2009, the U.S. has really outperformed international markets. You can see that S&P was up 331% from 2009 to September 30th, opposed just to 115%. For all the countries, excluding the United States. So, and you can also see, if you just the kind of tail end right here, when we had that pullback here in January and February, the United States recovered where internationally other countries did not. And so that's been one of the reasons why a diversified portfolio, when you had a fair amount of your investments in international stocks, why it's underperformed, because internationally things have just dramatically underperformed U.S. This year. And that's one reason why we're 100% out of international stocks as of a few months ago, just because of this pretty immense diversions between U.S. and international markets here. And again, just to give you a little bit more detail, again, just as you can see that the U.S. here in this line is certainly the top performing major economy, and see followed behind Japan, emerging markets, and Europe. With that being said, again, markets will continue to change, and there will certainly be opportunities internationally at some point in the future. Right now, I'm kind of staying away from international stocks, but again, when things are beaten down that badly, there will certainly be opportunities in the future. We're just not sure when those opportunities will start kind of heading in the right direction. So off to the charts. So what I want to share with you, actually before I go to the charts, I put together a portfolio in Morningstar of just the major indices right here. And so these are actual ETFs that you can own, and I just picked these ETFs because they represent broad markets. So if you actually look at the Vanguard BNDX, you can see that year to date it's up a little over 1% when you include the dividends, and you can see this column right here is how these sectors have done in the last 3 months. So we got BNDX is down. I mean, everything is down in the last 3 months. Here's the U.S. bond aggregate, the AGG. That's certainly down. We also have emerging markets bonds that are down. We also look at emerging markets. A couple different. These are emerging market government bonds and also just emerging market corporate bonds. But the point is that you can see a big drop in just fixed income across the board. And you also see right here the S&P 500. Again, we're barely breaking even. We were up as high as about 10% this year. Obviously, we've lost all those gains this week and over the last couple of months. You can also see the NASDAQ is still the strongest sector year to date. But again, the last 3 months it's down over 8%. But when you look at the Vanguard Total World Market, which is basically everything other than the United States, again, we're down over 6% in the last year to date, over 8.5% in the last 3 months, followed by European stocks. That's Europe, Australia, and I forgot what the FNE stands for, but that's basically the index that represents the majority of international stocks as well. Emerging markets down, and as well as China has taken the biggest loss over the last year or so. So again, China has really been struggling with their economy and their markets in the last year or so. Again, I think the tariffs have had a lot to do with that. So kind of going back to the charts, what I always like to do is kind of break down the the individual sectors of the S&P. You can see the S&P right here has lost all of its moving averages, even the 200-day moving average. So here we are. We started here in January. We had the melt up. We had the big correction. It kind of squandered a little bit more before we had this nice little run between April and into September, and then boom, the market just kind of fell out of bed. So this is what the overall market's doing with the S&P, but also, and this is also on a weekly chart right here. But again, the sectors that have remained the best kind of year to date are technology, consumer discretionary, healthcare, and we also seen utilities have also done fairly well. And one of the charts that I like to kind of show here, when you actually want to really drill down to the sectors that have done well kind of year to date, you can see that healthcare, utilities, and technology and energy have been the top performing sectors year to date. But what's neat about this is that we can actually kind of break down the indices into different sectors. And so if we take healthcare, for example, we've got medical devices and healthcare plans and medical care, and we can actually kind of drill down into the industries that have been doing the best. So let's say if I take medical devices, for example, one of the top stocks in there is Tandem Diabetes Care. which is done fairly well this year. It's got a beautiful chart and a little bit of a pullback right now. But these are the things, if you really want to kind of drill into the different sectors and see what's going on, this is one of the tools that we use. Other thing I want to kind of show you right here, other than the sectors, is that just kind of show you how difficult it is to make money in fixed income. So again, I've shown this before. These are all of the no transaction fee ETFs on the Schwab platform. And if I just rank these, well, just rank these to the best, to the worst, just year to date. And you can see that the Vanguard International Bond Fund is just going to kind of barely treading water. And again, we have FLRN, which is our floating rate funds. And again, we own a number of these ETFs in our portfolio. But I just want you to look at the sea of red that, this is what we have to choose from, and just on a real simple basis. So we look at the AGG, which is the bond aggregate. We're down 4.25% year to date. Here's the Vanguard BND, down about the same. We look at other sectors. PGX, we've owned this before. This is the preferred portfolio, down 5.85%. PIMCO, one of the best bond managers in the country, again, their core corporate bond fund is down 6.25. And again, we look at E-bond, which we've owned in the past. Emerging Markets Capital is down 11.5%. So one of the challenging things about fixed income right now is that there's just not a whole lot to choose from. And so what we're ultimately doing is owning short duration, high quality positions, and that's ultimately what you have to do in periods like this. So anyway, the fixed income markets are very, very challenging. And again, I kind of go back to my Excels right here. And again, when you're looking at the sectors that are doing well, and one thing I can do is look at what are the sectors that have done best in the last 5 trading days. Well, consumer staples are starting to come up a little bit. Real estate, we've also seen utilities, and again, these tend to be defensive positions. So we've been seeing a lot of volatility, a lot of chop in the market. The good news is that earnings are coming out, and we've seen some good earnings that are out there. Again, I just go up to XLK right now. If I just put this on a daily chart, you can see that we've had a nice little comeback today, but you can see also that the trend has certainly been negative. So the question is, what do you do at this point? Well, the answer is that again, now's not the time to panic and sell. We've got to get through earnings season. And again, we've got an election in a couple weeks. So if you can kind of hang tight, and also this would be a time to look at your watch list if there are any particular stocks that you want to own, if there are any particular sectors that you'd like to own. Now's the time to start doing that research, because when things start to rebound, that might be a good time to kind of rebalance for the last part of the year. So again, just to kind of wrap things up, what's causing the market volatility is rising interest rate, a global, just overall fear of a global slowdown due to tariffs, and again, we've just seen indiscriminate selling going off just in the last couple months. But hopefully we will see a support level right here on the S&P. Again, we don't have a crystal ball, but the bottom line is that we're just going through a volatile period right now. We're looking at this stuff carefully. So obviously no one likes to see negatives on their investment statements, whether you're a client of mine or you're just looking at your 401k accounts. So again, if you have any questions on your specific portfolio, you want to review, just certainly feel free to call my office. Again, the number is 301-588-0514. And again, if you're not a client of mine, again, we always offer second opinions and in portfolio reviews. And so again, it's no cost, no obligation, but if you want us to look over your portfolio just to kind of see how you're doing, we were happy to do so. So listen, I'm going to kind of wrap this video up here. Hopefully this was helpful. Again, if you guys have any questions, certainly contact my office. Until then, have a great weekend. We'll talk to you later.